So we're going to look at Benefytt Technologies, and we're going to calculate the intrinsic stock price of the company using prior financial information. So the first step is we need the market cap, which is 303.68 million. And now the stock price is 21.51. And next we need the free cash flow. And that's in Google Finance. And the best way to calculate the stock price for a company is to estimate the future free cash flows and then discount that number back to today's dollars. Next, we're going to get the net income. And although net income is used in the model, you generally don't use net income to calculate the value of a company. And the reason for that is because the income statement reports non-cash items and they use accrual accounting. The next is the total revenue, which is the sales for each year for the company. And it looks good that the company doubled their sales from 2016 to 2019. Always a good sign when you're investing in a company to see that. Now we need a capital structure of the business so we know what to discount the cash flows by. First, we have interest expense, because that's the interest that the company pays on its debt. Then we need short-term debt, and that can be found on the balance sheet. And short-term debt is debt that's due within 1 year. And now we need long-term debt. That's debt that's due beyond 1 year. So they pay 3.16% interest on their debt. But interest payments are tax deductible, so we need the effective tax rate. And we have to go back to the income statement. The income before tax is 46 million. And the income tax is 10 million. So the effective tax rate is 21%. So if you deduct the interest rate from the effective tax rate, their cost of debt is 2.48%. Now, let's look for the cost of equity, and we need the beta to figure that out. And the beta is 1.16. Beta is the volatility of the stock. And as you can see, the cost of equity is a lot higher than the cost of debt. It's 11.23%, the cost of equity. Because equity is always more expensive than debt because it sits lower on a capital structure. Therefore, it's a more risky of an investment. So the weighted average cost of capital is 7.99%. So you could say it costs, this is the cost to this company to obtain financing. So if the company isn't able to generate at least 7.99% in operating their regular business, they will not be profitable and they will eventually go out of business. So that's something to think about when looking into a company to invest in. Now we calculated the cash flows up here from our inputs earlier, and then the discounted cash flows are down here, and the sum of these amounts is $928 million. So that's the value of the company according to this model. And if we divide that by 14 million shares, we get an intrinsic value of $65.75. So it's trading at a 67% discount. Now, if you look at the stock price over the years, it's never even it's barely broken 30. So it has been trading at a significant discount for a while, and there's a number of reasons for that. Maybe people just aren't aware of this stock, so they haven't bid up the price, or they just don't think the future of the company is viable enough to keep that $65 stock price. They feel 21 is more appropriate. So let me know in the comments what you think of this video, and if you want me to do other videos. Thanks for watching.